Andy, one of the lines that jumped out to me was we anticipate impairments in the second half will be lower than those recorded in the first half. And I think you've just reinforced that impression of how you see the rest of the year. How much is that contingent on governments remaining engaged in providing financial support to the furloughed and those at this point who are in uncertain employment situations?
I think for all banks, the level of impairment that they take going forwards is clearly going to be hugely dependent upon how quickly things settle down. And clearly government action on multiple fronts, in this country furloughs, in other countries different things, is very, very important to that. It's not the only factor, but it is very important, and it's their action obviously on health fronts as well. So I think the statement that we have got an anticipation that the impairment should be lower in the second half is based upon the assumption that the situation as we have it today doesn't get worse. But if it does start to get better, then hopefully we can comfortably operate within that sort of zone.
Andy, looking at your net interest margin, it's dropped pretty significantly to 1.4% from 1.66% at this time last year. Clearly, that's driven in large part by the lower interest rate environment. What can we expect for the second half?
Yes, so in March in particular, when we saw the sharp cuts in interest rates, it was very clear that the margins for us, and indeed for many of our competitors, would be lower going for a period of time. And we guided in April when we did our first quarter results that we expected the income to be lower as a consequence of that. So I think the margin is possibly going to go a little bit further, but I think we have gone the largest part of the way down. I think the other thing to remember is that the interest income is less than half of our income overall. So yes, it is a big dependency, but it is not the only one. And actually in other parts of the business, particularly our financial markets business, the one that deals with interest rates and FX rates, it had a phenomenal first half, income up 35% year on year, and that now actually represents about a quarter of the group's income overall. So interest rate side is under pressure. The non-interest rate parts of the business have been very, very buoyant.